This section of the discussion focuses on the capital asset pricing model from the introduction lecture. During the introduction discussion, the claim was that to partake of options investing, one first needed an underlying asset. Stocks became the asset of choice for discussion purposes. Therefore, to better understand stock pricing, here the focus is on the capital asset pricing model, including alpha and beta calculations. One variable to plug into the capital asset pricing model is the risk-free rate, which, in this case, the discussion assigns the 1-year U.S. Treasury bond, as shown in the light blue section of the pyramid. The 1-year U.S. Treasury bond is risk-free because the United States government guarantees the interest and timely payment. The main discussion begins by reviewing the structure and purpose of the capital asset pricing model. In finance, the capital asset pricing model is a model used to determine a theoretically appropriate required rate of return of an asset to make decisions about adding assets to a well-diversified portfolio. Detail of parameters, the input variables, come later in the discussion. For now, the discussion considers how the capital asset pricing model can be manipulated to derive meaningful investment data for analysis. The first manipulation derives the asset premium by subtracting the risk-free rate from both sides of the equation as follows. The asset premium is the rate gained above or lost below the risk-free rate. The asset reward to risk is effectively the asset risk premium. Dividing both sides of the last equation by beta obtains the market premium as shown on the right side of the equation. Sometimes one might want to determine a market rate by employing the other parameters as inputs. The market premium is the market rate gained above or lost below the risk-free rate. The market reward to risk is effectively the market risk premium. Dividing the asset premium by the market premium derives the actual portfolio beta. In finance, the beta, or market beta, or beta coefficient, is a measure of how the individual asset moves on average when the overall stock market increases or decreases. Beta is a useful measure of the contribution of an individual asset to the risk of the market portfolio when it is added in small quantity. Beta is referred to as an asset's non-diversifiable risk, is systematic risk, market risk, or hedge ratio. Beta is not a measure of idiosyncratic risk. There is a pure statistical model for beta that involves employing covariance and variance terms, which can have a value of beta different from that of the previous model. Demonstrations for making these calculations come later in the discussion. The covariance and variance model can lead to the derivation of another statistical form of beta, mainly one that deals with the correlation between asset and market data and ratios of standard deviations. This discussion will not go into this latter form. However, expect this form to appear in future discussions. The security characteristic line is a regression line, plotting performance of a particular security or portfolio against that of the market portfolio at every point in time. The SLC is plotted on a graph where the y-axis is the excess return on a security over the risk-free return, and the x-axis is the excess return on the market in general. Through a series of mathematical manipulation, one can derive alpha as follows. One might recognize this last derivation as the asset premium minus beta multiplied by the market premium, not taking into consideration the minus epsilon. Alpha is a measure of the active return on an investment, seen as the performance of that investment compared with a suitable market index. An alpha of 1% means the investment's return on investment over a selected period was 1% better than the market during that same period. A negative alpha means the investment underperformed the market. The discussion next moves forwards to explain each of the input parameters for each variable that is of interest to the discussion, starting with the capital asset pricing model. When looking at the capital asset pricing model, whenever an E is encountered with something in parentheses, that means expected, which is an estimated value. Whenever an R is encountered, that means rate of return, or simply rate for short. So for the first line, E with respect to R sub I is the expected return on the capital asset. R sub F is the risk-free rate of interest, such as interest arising from government bonds. Beta, shown as the lowercase Greek b, is the sensitivity of the ratio of expected excess asset returns to expected excess market returns. E with respect to RM is the expected return of the market. E with respect to R sub M minus R sub F, or the expected market rate minus the risk-free rate, is the expected excess market return, sometimes known as the market risk premium. The expected excess rate minus the risk-free rate is the expected excess asset returns, sometimes known as the asset risk premium. Expected and risk-free rates were covered, as was the purpose of beta. A detailed explanation of the covariance and variance versions of beta comes later in the discussion, leaving the rho and sigma parts. Rho, the lowercase Greek r, denotes the correlation coefficient between the investment I and the market M. Sigma, the lowercase Greek s, with respect to I, is the standard deviation for the investment I. Sigma, with respect to M, is the standard deviation for the market M. The covariance, variance, rho, sigma I, and sigma M are all statistical terms that require more explanation at some later time, but not for this particular discussion at this time. Nonetheless, calculation of all statistics, except for rho, are part of this lecture. For the security characteristic line, there are only two new variables. However, other groupings of variables are now given definition. The first new letter is alpha, lowercase Greek a, is the asset's at normal return. Beta times the market premium is a non-diversible or systematic risk. The discussion has covered the market rate and also the risk-free rate. Epsilon, the lowercase Greek e, is the non-systematic or diversifiable risk. Epsilon can be decomposed into the difference of the square of the two standard deviations as shown below. With this final form of alpha, one can begin the process of calculation and analysis. Adopting the 1-year U.S. Treasury rate makes finding the risk-free rate simple. In this case, one can look up the rate directly on the CNBC website as shown. For the day shown, the risk-free rate is 5.275%. With respect to the capital asset pricing model, one can find the 1-year parameters for the market and asset portfolio as shown. In this instance, the market indicator is the S&P 500 and the asset is Amazon. For clarity, one does not have to utilize the S&P 500 to represent the market. Other indexes such as the Dow Jones might be better suited for other analysis. With time and practice, the skill set for picking indexes becomes sharpened. Putting this information into the capital asset pricing model derives the actual beta with respect to Amazon, which is 1.5095. However, this is not the entire story. There remains the covariance/variance version of beta. Notably, how does a statistical beta relate to an actual beta? The discussion must therefore continue. To compute the covariance/variance beta model, there is a need for historical data. One can easily find this data on websites like finance.yahoo.com. On this page is another printout of the S&P 500. It also comes with the needed historical data. First, take a quick look at the charted data. This is what historical data looks like when charted. Notice the presentation of historical data is in columns. The one of interest with respect to the discussion is the closed column. For now, this is the only column needed to do any required calculations with respect to the capital asset pricing model. Nonetheless, for the sake of completeness, the discussion will spend a few seconds going over the other columns of historical data. The open price is the starting or beginning price for the day. The high is the highest price paid for the S&P 500, while the low is the lowest price paid. The close is the final price paid for the day. The adjusted close is the closing price paid after adjustment for all applicable splits and dividends distributions. Data is adjusted using appropriate splits and dividend multipliers adhering to the Center for Research and Security Prices standards. In capital markets, volume or trading volume is the amount of security that was traded during a given period. Before computing the covariance/variance beta model, one should manually compute the actual beta model as a data check. This next slide seems to have a lot going on. Nevertheless, as the title states, the purpose of this slide is to manually calculate the market rate. The discussion starts by considering the time period and close column, both outlined with blue rectangles. Notice the time period covers 366 days instead of 365. The reason for this will become clear during the next discussion covering the spreadsheet. Looking at the close column, specifically the first two rows, one calculates the daily rate by taking the close of the day in row 1 and subtracting the close of the previous day in row 2 to obtain the daily rate in dollars. In this instance, the daily return is $4,388.71 minus $4,409.59, which yields a negative return of $20.88. By dividing the daily return by the close from the previous day, one obtains the daily rate. In this instance, the daily rate is a negative $20.88 divided by $4,409.59, which yields a negative rate of 0.47%. Therefore, the market rate with respect to the first row is 0.47%. One repeats the process for row 2, then row 3, continuing until all rows, except for the last row, have a corresponding daily rate. Once all daily rates are known, one needs to add all the rates together for the given time period to obtain the final rate. In this instance, the 1-year rate for the market, which is 17.2547%. It is probably clear at this point there are a lot of calculations involved in achieving the desired outcome. Nonetheless, one can reduce the amount of manual work needed by copying and pasting historical data into a spreadsheet as shown. Column I shows all calculations for the daily rates. Notice the first row to calculate is row 3, since that is the first row containing relevant information. In most cases, one need only manually type the RMI equation for the first row, then copy and paste that equation for all remaining rows. Once complete, sum the column by placing an auto sum formula at the bottom of the column as shown. Repeat the process to find the 1-year rate for Amazon. Copying and pasting the historical data and making required calculations as was done for the S&P 500, one obtains the following. The value for the 1-year rate of return is the same as before, that is 23.3588%. Consequently, the beta value is also the same, or 1.5095. Since the discussion now has enough information to calculate the covariance/variance, the purpose of this exercise, it is time to demonstrate how to make beta calculations when employing the statistical method. Recall the structure of beta and its relationship to the covariance/variance model. As shown, covariance and variance calculations can appear a little involved, especially when doing them manually. However, most spreadsheets come with built-in automated covariance and variance functions, which, when properly employed, serve as real-time savers. Before getting into any built-in formulae, the discussion first reviews the covariance and variance formulas and explains the process for manual calculation. Starting with n equals 250, where n is the number of rate elements with respect to both the asset and the market. Remember that n can be any number needed for a specific calculation. Here, n equals 250 means there are 250 elements for the rate with respect to the asset and 250 elements for the rate with respect to the market. If n equals 125, then there are 125 elements for both the rate with respect to the asset and the rate with respect to the market, or about 6 months worth of data for the beta model. R sub A is the 1-year rate calculation for the asset, and RM is the 1-year rate calculation for the market. By dividing each of the 1-year rates by n, one obtains the average daily rates for the asset and for the market. The average rates are needed to compute both the covariance and variance. The symbol mu is the lowercase Greek m. Mu represents the mean or average. Whereas R sub A and R sub M are sums of daily rates, R sub AI and R sub MI are daily rates where I represents the index to be summed. Looking at the top line to the left with respect to beta, the full statistical beta model appears. Notice the approximately equal to sign, the squiggly lines, instead of a simple equal sign. This is because the covariance/variance beta model is a strong statistical estimate of how the asset is performing compared to the market. For a quick review of math, the ratio of two numbers is called a fraction, which is given by taking a top number, called the numerator, and dividing it by a bottom number, called the denominator. For the covariance/variance beta model, the covariance represents the top number, or numerator, and the variance represents the bottom number, or denominator. The bar between the ratio or fraction makes it clear what is on the top and what is on the bottom. As shown, one calculates the covariance or numerator by taking a single daily asset rate and subtracting the average daily rate with respect to the asset. Start with the first daily rate with respect to the asset and save that value. Next, perform the same calculation for the first rate with respect to the market and save that value. Next, multiply the value saved with respect to the asset with the value saved with respect to the market. Save this value. The black dot between two sets of parentheses indicates multiplication. Continue this process for each row until all rows have a multiplied saved value. Add all saved values and divide by n, which in this case is 250. The variance will follow the same process, except instead of multiplying two different values, an asset value by a market value, one multiplies two of the same values, in this case, two market values. The second line, which technically is not the covariance divided by the variance, represents a shortcut version of the first line. Nonetheless, the beta of the shortcut model is the same as the long version. The shortcut version demonstrates two things. The first is that the ratio of the quantity of 1 divided by n divided by the quantity of 1 divided by n is equal to n divided by n, which is equal to 1. The second thing the shortcut demonstrates is that with respect to the variance, since one is multiplying two of the same values, one need only write the value once and then write the number of times the value needs to be multiplied, as noted by the red number 2 written in the upper right corner of the parentheses. Shown on the third line are the results of calculating the covariance/variance beta model. To be clear, the ratio written in blue demonstrates the covariance value in the numerator and the variance value in the denominator. One might have noticed the statistical beta is not the same as the actual beta. The two are close but not exactly equal, which explains the need for the approximate sign. Before determining what the difference between the two betas represents, the discussion first demonstrates built-in statistical calculations to confirm the value of the manually calculated statistical beta. The calculation value for built-in statistical formulas confirms the statistical beta value from the manual calculation. Built-in calculations can be done in both Microsoft Excel as part of Microsoft Office and with OpenCalc as part of OpenOffice. OpenOffice is a free software version of Microsoft Office. Setup for covariance and variance calculations is simple. All daily rates with respect to an asset are in column I from row 2 down to row 251. All daily rates with respect to the market are in column M in the same corresponding rows as the asset. One can now type formulae into the spreadsheet as shown to obtain the covariance and variance models. Calculation of the variance is for both the asset and market, since both variance models become needed during the alpha calculation. The two beta models, actual and statistical, should reconcile. The actual model of beta naturally agrees with itself. Employing the actual beta in calculations produces the expected value for the 1-year rate of return. When employing the statistical beta, the expected rate of return is higher by about 0.899% to become approximately 24.25822%. The statistical beta seems to suggest the current price of the asset should be higher. One could also interpret the higher rate as the S&P 500 overestimating the market, which could be around 16.68713% instead of 17.2547%. Reconciling actual and statistical beta models can be as simple as taking the average of the two, so that the final expected beta is closer to 1.54707. Adjusting beta by averaging the actual beta with the statistical beta is a good fit for the model. The discussion next considered the alpha calculation, specifically the epsilon of alpha. Epsilon is the sigma squared, which is the square of the standard deviation with respect to an asset, minus sigma squared with respect to the market. However, the square of the standard deviation is the variance. Therefore, epsilon becomes the variance with respect to an asset minus the variance with respect to the market. Both the variance for the asset and the variance for the market were calculated previously. Putting these values into the calculation for epsilon gives a result of 0.055027267%. One can now make a full and precise alpha calculation as shown next. The discussion has come to the summary for the alpha calculation. Inputting all appropriate data gives a result of negative 0.9544279%, which means the investment underperformed the market by about a negative 1%. This result agrees with the result that the asset is undervalued for the given date range. Notice alpha calculations only employ statistical betas. This is because alpha calculations incorporate variance calculations, as statistical betas are more appropriate when variance calculations are involved. That concludes this lecture. Thank you for watching the video. If you liked the video, give it a thumbs up and remember to subscribe.